morning, traders. Welcome to the weekly Elliott Wave Street update. I'm Juan Maldonado, and it's a pleasure to start the week with some of our wave counts. We have a fantastic membership with a daily analysis, strategies, education, and more. So let's talk about the euro. The euro has been climbing after the CPI report. So we are going to talk about what I was thinking before, what I'm thinking now, and how to validate this wave count. When we are finding the end of a trend, Elliott wave is really good because let's say that a trend has been moving down and we look for a 5-wave sequence in the opposite direction and a 3-wave sequence down. So when you are learning the Elliott wave theory, you get excited, and no matter the time frame, when there is a 5-wave sequence, you say, okay, I have a 5-wave sequence. I am going to find, let's say this is a wave 1, as a wave A, whatever, and you're looking for wave 2, and you say, okay, I'm going long because price hits the 61.8% Fibonacci level, 50%, or I have a hammer, or I have a divergence in an indicator, or I'm using a price action and I like what I'm seeing here. Any reason, right? You are looking for any reason to have the buy trade, and you ask the trader, okay, so why you were trying to buy the euro or whatever instrument you're trading? And the answer, is because it's wave 2. And I read a book about Elliott wave, and it says that when you have 5 waves on the left, at the beginning of the leg is a wave 1, and you can do anything during wave 2, and you leave a protective stop loss here, right? But what if after the first leg or directly, whatever, you start seeing candles like these big candles? The price is going to continue. And no matter that you have a 5-wave sequence on your left, the price is going to continue. Because the impulse in Elliott wave, or the whole pattern, is not just a 5-wave sequence. It's the 5-wave sequence plus the 3-wave sequence. 5 plus 3. But plus 3, the corrective wave, needs to have special characteristics in order to have a validation. You can't trade just because you think it's a wave 2. No, you need to add some supply and demand reading to this area. So when we have the corrective wave, let's say after the corrective wave, the C leg is likely to slow down, is likely to be choppy, is likely to have smaller candles, is likely to have trouble to continue lower, then a rejection, and that's the validation for the pattern. So all this pattern, the validation comes here after the ABC. And if it accelerates, it's not an impulse, it's something corrective. And from here, you are going to start finding out from this area what is happening. So look, if we have this 5-wave sequence, first of all, we have to be careful because a 5-wave sequence is not guarantee of anything, as everything in trading, right? There is no 100%. So in the euro, right now we're here, right? In this map, in this market map, the euro is building a wave 3. And in order to have the low fixed as the end of the bear market, we need to have the completion of 4, 5, and the corrective, right? So 4, 5, and a nice ABC losing momentum. It could retrace 50% or 90%, we don't care, but the momentum is key, and having the entry, right? So without the 5-wave sequence, we can't tell that this is the bottom of the market yet. Looks like, and the probability is huge, especially after the CPI with this strong move up, but there are some other steps that the euro needs to complete in order to confirm that what we are seeing is actually true. The other important aspect here is that if price fails to complete the impulse, what if the price rejects, right? What if the price starts selling off strongly and crossing this area? Those scenarios are possible when we are building our first leg up. But anyway, that's just to have that confirmation pending. But for now, we are following the move up. Today in the daily video inside the membership, we talk about supply and demand, how to validate candle by candle the end of a wave, because that's what we do in Elliott Wave, not just drawing waves, also learning when they finished, when they are done, right? So here we have a nice demand today in the morning, here looking for a hard high, that's the bias. So look how important it is to understand these setups, because if you're scalping, if you are day trading, all you need to do on lower time frames is find bullish trades when you have a wave count on a higher time frame that is telling that the market is likely to continue higher, right? So you go to the lower time frames and you use your moving average strategy, you do your magic there, or price action technique, or anything that you like to use. And on lower time frames, you just you filter out the short trades and you just go with the buy trades, because the wave count on the higher time frame is telling that we are coming back here to the previous high, and filtering out those trades, those low probability trades. If you're scalping, if you're day trading, is something fantastic. This is a great addition to your trading. Let's have a look at the S&P. Or before we go to the S&P, let me share with you what I was thinking last week. Last week, I was expecting something different, actually. I was looking for this leg as corrective, this thing as corrective, and I was looking for a leg down. So one of the key things when we are trading is that if we trade at the market extremes, if we sell here, or if we sell here on this area, look at the beautiful rejection, we have an edge, we have an advantage. The problem is when you sell too far from the high, because the stop loss is huge and then you don't have enough time to do something. So after the CPI report, we have this huge acceleration, and I wasn't expecting that, and I think that most participants in the markets were not looking for that type of price action. It was actually a big surprise, because it was clearly something unexpected, right? In all the markets, this was crazy. Let's have a look at the S&P. On the S&P, it's interesting because we are looking for the continuation. We are looking for the price to continue a little bit higher here. I have some concerns about the S&P. Last week I was looking for some ABC here to go long. The price departed before. Okay, that's fine. But look, the Elliott wave structure, here is an extension, wave 1 and wave 2, and wave 1 and wave 2 again. So the wave 2 on an extension should be small, should be fast, right? Should be something like this. Price maybe could re-enter this 3900 area, whatever, but reject fast, right? We don't want to have an acceptance here of price moving sideways or creating some sort of profile here or something. We just need to have price moving down and rejecting fast. And if that's the case, imagine a bullish engulfing candle here, whatever, a couple of green candles. That's the entry, right? That's the entry to capture a big wave 3, we're saying 500, 600 points. So that's the bullish scenario. But what if price this week starts selling off like strongly, crossing this area strongly? Another red candle. From this candle, you can start seeing the difference, right, between an ABC corrective wave and something that is not looking like a corrective wave. And from this candle, you're going to say, oh, this is not working as expected. And the price, it is likely to continue lower and probably cross this area. So this will be a short bias. If you are scalping, if you are day trading, from there you're going to say, oh, I need to follow the leg down. It's likely to cross this area, the S&P then, and probably make a lower low, right? So in that case, this will be an ABC, and this will be a bear market rally, and we just follow the trend down. So speed matters, and matters a lot, because imagine someone buying because it's a wave too after these huge candles. Of course, it's not going to work. So that's something that you can add. If you're looking for a corrective wave, if it's going fast against you, you are not going to trade. If it's going slow, losing momentum as an ABC, rejecting, you are going to trigger the continuation. But never trade after huge candles going in the opposite direction that you are thinking, because clearly money flow is moving in that direction, and there is no wave count that you can draw in your chart that is going to stop that. Or if you do crazy things, buying on the downtick is going to finish extremely bad, that sort of decision. So be extra careful. All right, so the plan will be there to follow the market, and let's see which one is going to validate. Traders, if you want to participate in this process where you can learn the Elliott wave theory with us, with live market examples, with everyday lessons in the video, with education, and a lot of things that we have inside our membership here on ElliottWaveStreet.com, you can sign up. We have the Forex, the stocks, or the full access plan. There is a special where the first month is on $19 and then $75 per month, and you are getting access to a fantastic world of Elliott Wave with clear trading plans, with clear education. We talk about institutional cycles, supply and demand, momentum, and a lot of tools that are going to help you improve your trading. So I'll see you inside the membership. Thank you very much for watching this video. Don't forget to subscribe, and I'll see you soon. Take care. Bye-bye.